Okay, so basically we are recording now. We are recording now. Okay, so basically, what I was sharing is, the setups for last week that we could have entered. This is a naked chart. We call it naked chart because there are no indicators here. Whereas on the same chart, on a different window, I do have indicators on here. The indicators basically help me, and help traders generally know or get an idea of which direction the price is going, whether up or down. We're not going to be going into full details as to how to use them today, but because we have done that before, but I'll just quickly explain. Okay, so on this one, for instance, we would usually be looking for a sell when we have the blue candle above the yellow candle. And some of the things we learned recently is price action as it relates to the size of the candle. Some candles are obviously bigger than others. Let's just make it bigger. Some candles are bigger than others. You can tell this candle, for instance, as a matter of fact, let's take the wealthy place indicator off. Take off the wealthy place indicator. Okay, so this candle, for instance, you can see it's big compared to previous candles. I mean, if you consider this candle, just look left. The previous candles were, some of them were big, others were small, others were medium size, but this was indeed a big move. And usually when you see a big candle like this, it means perhaps there is an event. Big candles are usually event driven. Maybe they've just announced some interest rate increase in interest rate. Who knows, maybe Donald Trump has just won the election or something. It moves the market, either up or down. So this was most likely an event. Sometimes it could be just one big candle. Other times it could be a series of big candles or a mixture of big and small candles. It could be in either direction, either down or going up. So this was definitely, I believe, an event, or it could be the beginning of the trading day, the market open. The market open usually usually because a lot of traders have just come into the market and they either push the price down or push it up, the volume. So when you see a big candle like this, when it's close to a moving average, in this case, this candle is close to or on the 10 SMA, 10S simple moving average. If it's either close to some key moving averages, the 10, the 20, the 50, and the 200 tend to be key. When the price moves away from the moving average, know that it's most likely going to continue in that direction. In this case, it was a drop. You can be sure, to jump in here, and it will give you usually an equal size. So if you consider this candle is from here to here, that's about 24 pips. I know some of you are new here. I would explain that some other time, don't worry. About 24, 25 pips. If you were to take the trade, you see it could have given you something close. On this occasion, it gave you about 19 pips. But guess what? If you were looking for 24, 25 pips, it still would have given it to you, except that, because you entered the price, the market, the trade here, you place your stop loss above there, that is red. You enter here. Let me mark it as yellow broken lines. So you can see I've put a yellow broken line on the chart here, and there's a red solid line. Usually on my chart, if you see a yellow, if you see yellow broken lines, know that is where I would have entered the trade or where I entered the trade, the market. If a red line is where I closed out, it basically means my price, the price or the market went against me. When I entered the market here for a sell, because I thought the price was going to go down, but if it went up, it means it has gone against me. If it goes to hit my stop loss, it means I've lost that trade. But if it continues down like I anticipated or analyzed, then I would have won that trade. So with this trade now, seeing a big candle coming off the moving average, I would have entered here for a sell. I will quickly measure from here to here, which is 24 pips, or perhaps, ignore the wick, which means I won't measure from here. I'll measure from where the body is. I'll just measure the body. That's 17 pips. If I measure the body in this case, guess what? I got my 17 pips. If I decided to play it safe, if you go with the body, the size of the body, you would almost definitely get it. Perhaps like 80% of the time you will get that. Guys, that is a high winning probability. So enter the trade and know that you are going to win 8 out of 10 times. Guess what? Even if it's 7 out of 10 times, that is very good. So what I am saying is, even if from today you decide this is the only strategy I will trade, it means that you're going to be winning 7 out of 10 times when you trade. So that's if you go with the body. But if you were to measure the whole thing from the high of the candle to the very low, which is like 24 pips, if you entered here, it came here, it didn't give you 24, but guess what? It now went up. You were still in the trade because it did not hit your stop loss. So you entered here, came down, went against you. You were now in a drawdown thinking, ooh, it appears I'm going to lose this trade. I'm going to lose this trade. No profit today, no profit today. Boom, it came down and gave you more than the 24 pips. My goodness. Guess what? If I haven't taught you anything in trading, if this is the only thing you learn from me, I am glad, because it's a strategy that wins. What would now happen is you have to develop patience. You can't just enter any trade. If it is the case that this is one of the strategies you trade, just be patient. If you only have 3 hours in the morning to trade, because when we come trading together in the mornings, we usually stay, well, these days we stay less hours. Before we used to stay 3 hours, but now, if you say, oh, I only have 2-3 hours to trade in the morning before I go to work or go do other things, if you do not see this setup in the market, just leave it, just forget it. If this is what you know to trade, if you don't see this setup where there's a big move in one direction, either coming down, I'm going to be showing you an example of one going up as well. If you don't see this setup, just leave it. Know that that day was not your day. Oh yeah. It's better to actually miss a trade, like we say. It's better not to trade at all than to lose. Well, yes, we know as Forex traders, we will lose some, we will win some. At the end of the day, we want to win a whole lot more than we lose. I'll take that again. We would win some and lose some, but we want to win a whole lot more than we lose. So if you are waiting for only this big move, I would usually call some of these I will call this big candle a couple of names. Institutional candles, because sometimes the institutions are the ones responsible for such price movement. Institutions like the banks and the hedge fund. Yes, the bank do trade. When you put your money in the bank, you think it just sits there. How do they pay you interest? They trade it overnight, usually. They trade your money. So it's usually a bank or a hedge fund that that is responsible for such move down, big move down or big move up. It's not usually retail traders like you and I. You and I are retail traders. We don't have it in us to move. We don't have enough money to move the market like this. I might have a couple of thousands to trade. You might have a couple of thousands, but it doesn't move like this. It's only big banks. Maybe one big bank just sold a lot of their currency and the price drops, or maybe they bought a lot and the price went up. That's what happens. So anyway, some of them just to also share with you, when the institutions or when you have an event that moves the price, it might not necessarily be just one big candle. On some occasions, it could be just one big candles. On other occasions, it could be a couple of candles. Maybe in this case, the price is going down, drip, 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 a mixture of big and small candles. It could also still be an event-driven movement or an institutional-driven movement. Why? Because you will see, for instance, let's just take it from here. Some of these banks, a lot of these banks trade with robots. They trade with robots. So what they would do, instead of just buying, you can see it went up here. Just these two big candles, a big one, another slightly big one, and then a small one. So this was just a 3-candle push, but there was something responsible for this. Again, like I say, it could be just one big push or a series of candles. If it's a series of candles and it's going in one direction, know that the banks are also involved and they are trading with a robot. So what they've basically done is they've set their robot to sell or buy incrementally. To buy or sell incrementally, which means maybe buy, so much pounds, if it's pounds or dollars, buy so much pounds against the dollar every 1 hour or every 2 hours, every 30 minutes. So you will see the price just dropping, or just increasing, as opposed to just buying it all at once. You see, when the market, the institutions buy or sell a candle all at once, it means it will be one big candle. Guess what? They might not want to do that because it will be a shock to the system. It will be a shock to the market. On the other hand, it could be they've set the robot to buy so much every day. So when you see the price of the Naira going up against the price of the US dollar, it might not just rise from 600 to 750 in one day. It will be rising incrementally or steadily, but the banks are buying. Obviously, we know about market forces. It could be there's something wrong with the economy, and they are now, you see well, okay, in that case, it would be the reverse, because if the Naira is going up against the dollar, it means that, the value of the Naira is going down, and basically that's what it is. So it's either buying or selling incrementally, as opposed to if it drops like from 750, or so if it rises from 600 to 750 Naira to the dollar, there will be a serious shock in the system. It's almost as though the central bank would have to intervene. Well, I don't know if central bank is even bothered, but ideally, the central banks of some nations would intervene. If there's a sudden drop or a sudden rise, the central bank, because they are responsible for the finance, for the monetary system in a sense in the country, so because the banks or hedge funds would not want the central bank to intervene, they will steadily bring the price down or steadily bring it up. Okay, there's a comment there in the chat. Could you have entered using the same strategy after the bullish doji to the right looking candle for a sell? Okay, let me see if I was, which candle, which one? Let me see. Which area are you referring to?
It was on your screen earlier, the one you were showing earlier.
Could it be here?
No.
Here?
No, you moved to the right. You moved to the right, sorry. You know the one when you were showing? No, it's a bearish a long candle.
A bearish long candle.
The one where you gave an example that we could enter for 20 something pips.
Okay, no, I think it was this one.
No, was it that one?
Yeah, that's the one I was using for the example.
Okay,
You know,
you move to the right.
To the right, okay. So the question is, could you have entered using the same strategy after the bullish?
There was a bullish doji, and then there was a bearish candle came up, a pretty long one. So
okay,
the same strategy because it was bouncing off the 50.
Okay. I mean, anyway, yeah. I mean, the thing is, it works obviously, with the doji as well. So basically, if the candle is coming off from
okay, I've seen it now. So we move to the middle. Yeah, where your cursor is there.
Here.
Aha, that's the one. Yeah.
Okay, so the question is, what was the question?
I said, could you have used the same strategy using the doji as the bounce off and then enter on the close of the first bearish candle?
Okay, as in
yes.
As in selling.
Yes, as in selling.
Okay, yeah. I mean, with this one, I would have as well, because this red candle, came off the 50, and this one also rejected. They both closed under it, so suggesting that it's there's now a rejection in that area. I mean, otherwise, I mean, if I was still not quite sure, I most likely would have entered, because they both rejected and closed below the 10. I could have possibly, entered here. I know there's this. I know there's this huge candle, but then, because I know overall the price is going down, you can see the moving average lined up, the way we want it, the red, the blue, and yellow. I still would have entered, obviously with this huge rejection, I would apply the body. I would use the body instead of using the whole candle, because I know I might not necessarily get 30 pips here. So in this case, I would enter, if I entered here at the close of this candle, I'll place my stop loss there, say about 14, and we got, more than that. So, but the key thing to note, is that the price is rejecting at, it's bouncing off the moving average. I mean, obviously the confluence there is that we have the 200, the 50, and the 10 SMA lined up, the way we want. Okay, guys, I don't know if there are any more questions. I mean, let's look for a bullish example as well. But like I say, it's a powerful strategy. So guys, if we come in the mornings and we don't find our usual strategy, we will not take any trades. So obviously you understand, because when you do get a move like this, okay, something else I must tell you, which will help. Let's go back to that example. Without being afraid, when you get an entry like this, you will most likely get at least 2 or 3 candle pushes. So you entered here on this candle, the next candle pushing down, the second candle pushing down, and it began to go up. So you entered here, 1 candle stop loss. By the time this candle closed and got here, you would have moved your price. You know, this is a scalping strategy in a sense. It works on all time frames, but when we trade together in the morning, we are usually scalping now. You know, so if you moved, if the price entered here, it closed here. By the time it closed here, move your stop loss. As a matter of fact, this is about 11 pips. So you've already got 10 pips. You know, when you're scalping at 10 pips, really, you want to take some partial profits. So take some partial profits, move your stop loss just above, because each candle should be, you know, each move in your direction calls for you to move your stop loss to be in line with 1 candle stick stop loss. So by the time this candle closed here, the next candle will now be here. So at any time now, it will be just 1 candle stop loss. So by the time it closes, one closed here as well, if you've not taken all profit, at least this one closed here, you moved it there. This one then closed here. This one closed here. You moved the candle here. It so happened that the price now went up and took you out. But at least you've taken partial profits and you ended up with 7 more pips. You've gotten 17 pips from this trade. That's fine. You know, however, when the price moves, this happened to have been 2 candle pushes because it closed here. You know what? Let's use the naked. Okay. So it closed here. This candle, your entry candle closed here. 1 candle push, 2 candle pushes. By the time you get a 3 candle push, you might want to close all positions. You know, guys, I think I've said this before. Let's not be scared when we have this setup before us. You know, if you have this setup and you enter, don't be quick to just take 7 pips or 6 pips and close. No. You are not doing yourself any justice, because what then happens when it goes and hits your stop loss? You know, you want it to be that you win more than you lose, and even when you do win, you get as much pips as possible. So, you know, it's a strategy that wins like 80% of the time. So have confidence and stay in the trade and get at least 10 pips. If you want to close all 10 pips, close all the trades, then fine, that's up to you. But don't try to be closing before 10 pips. You know, expect a 3 candle push with this strategy if it's not too far away from the 200, that is. In this case, it's not exactly too far. I mean, it depends on how you stretch it. I mean, let me see. I have, yeah. I mean, with time anyway, you will get to know what you should do. I mean, there's no there's an element of discretion here in that I could say this candle closing, this candle here is quite far from the 200. Someone else will say it's not too far. Someone else will say it's okay. So, you know, when there's discretion like that, you know, you would have to go with your own discretion. But the more you trade this strategy, the more your discretion will be right, if you understand what I mean. You know, so at the beginning, you might think, oh, this is too far from the 200. The price has already moved too far from the 200, you know. But with time, you will get to know what is what. Somebody is asking for the link in there. We use the same link all the time. Anyway, Peter, I added you to the VIP group today. You know, the link I posted to you is actually in the pinned post, among the pinned posts in the VIP, Forex VIP room. So whenever we have training sessions, let me just send it to you know, that guy now. Just 1 minute. Okay, I think Yemisi is doing that. Okay, so basically, whenever we have any training or trading sessions, we do use the same link. So always, note that we use the same link. Oh, what's happening here? Just 1 minute, guys. 1 minute. Okay, let's send it to the VIP room. Okay, so whenever we are training, like we are training tonight, we tend to do our training Sunday evenings, and in the mornings we trade. We actually trade. Weekday mornings like Monday, Tuesday, Wednesday, Thursday, we are actually trading. I am sharing my screen like this as well, analyzing data, getting in trades and coming out of trades together. So you could join us tomorrow. We usually start at 8 in the morning. Try and come early, because sometimes we do find trades early. It's like within 10 minutes of joining, we just find a trade and we enter. So if you come late, it means you might miss some of those trades. So 8 o'clock UK time, is when we start, especially during summer months and all that. So anyway, let's just do for one more example. Again, for instance, we see a bullish candle, a strong bullish candle, and you can see it gave us a 2-candle push. So after a strong candle, we would most likely get at least a 2-candle push. So on this one, for instance, you would have placed the stop loss here about 21. Did we get 21? Well, we didn't quite get 21, but as a matter of fact, it came down here and went up. It gave us as much as 16 or 15. So you will not always necessarily get 1-to-1, but what I'm saying is most of the time, you will get 1-to-1. So from here to here, 20, let's say 22, we didn't quite get 22, but at least after getting your 10 pips, you've moved your stop loss, you've taken partial profit, and you are okay, which basically means even though you didn't get the full number of pips you were expecting, you still went out with a profit. It was not a loss, because after you get 10 pips, you move your stop loss to break, you move it up, and you take that. So like I say, when we get a big move like this, it will usually follow through with at least 2 or 3 more candles. Let's look for one more example to prove our point. Okay. I mean, this one, for instance, like we've also learned lately, these are not big candles in a sense. These ones are not big candles in a sense, but it's a continuous push up, a continuous move up. So what I did say is that when you get a big candle, you enter. If you don't get a big candle, you are getting, medium-sized candles like this. This is a medium-sized candle, medium-sized, medium-sized. Just take it as though it is one candle. Just combine it as though it is one candle. So just combine these 2 candles and take it as one. Take it as one big candle, and then enter here, put your stop loss here, which is like how many pips? Which is like, 15 pips, and of course you got a lot more. Wow, that's huge. So 15 pips for about 50-something pips. Now, I know some of you are new here. You are new to trading. All these terminologies I've used tonight, don't let it phase you. Guess what? In 3 months' time, you'll be sounding like a pro. Nobody will know you're not a pro. You would understand all the terminologies I'm using, or at least most of them, and you'll be taking these trades, like it's second nature. So this would have been another winning trade. So going back to what we just said, because we're looking at trades we would have taken for last week. So on Thursday, you can see here, this is Thursday. On Thursday, this would have been a winning trade. And like I did say to you guys, when the price moves, never mind the fact that you have the 200 that seems to be in the way. You might think, oh, 200 price is coming up to, the price is coming up against the 200. No. No, that's not what to consider. What to consider is the price, the fact that the price has, pushed up away from, at least in this case, from both the 10 and the 50 SMA. After all, this is like flat. The 200 is like flat. Anyway, this session is not, this part of the training is not for elementary. For those who just came in, we did the elementary or the basic, the foundational teaching at the beginning from about 7:15. So we're now doing what is slightly more advanced, and we are finishing now. If you like, I'm going to let you have some questions. But just for those who are a bit more experienced, know that, if the price moves away from the moving averages, especially when there are two moving averages close to each other and the price has moved away from them, even more powerful, just ignore the 200 in a way. It's going to break past it. Again, it's advisable you do back testing. Back testing basically meaning you go back in time. Like today, like this day was the market movement, the market trading on Thursday. If you go back in time by just moving your chart, you will come to another day. This is now Wednesday. If you keep going, you are going back in time. If you do your analysis, you will see that price would have played out. You will see how price would have played out. So you can see this is Wednesday now. There would have been another winning day. Why? In this case, the price is now below all moving averages. The 10, the 50, the 200. This would have been another beautiful winning day. And guess what, guys? When you see this, don't even be thinking of scalping. I'm teaching a whole lot more than I plan to teach tonight. I can't help it because we are seeing some things here. You see, when the price has moved below all moving averages and it's not quite far away yet, don't even be thinking of scalping. If you scalp, fine. But what I'm saying is think of going for more pips. Oh my goodness. My traders need to be hungrier than you are currently. Scalping is good, but if the market wants to give you more pips, more profit, why would you not take it? When the price is just leaving, okay, oh, I think this is a good setup. Let's see. Here, for instance, you can see here, the candle, the moving averages are just crossing, the way we want it. By the time we get here, let's mark it up. By the time we get here, the price is lined up the way we want it. Why? Because we have the 10 above the 50, which is above the 200. So what you now want to do is to just perhaps enter anywhere above where it's lined up like this, or wait for the price to come below, so you are not risking too much. Wait for the price to come below. When it goes above again, you enter here. Put your stop loss, maybe at some swing low below that. This is not a one candlestick strategy. Why? Because it's not a big candle. You're just trading the normal, MPP, my pay packet strategy, where you consider the arrangement of the moving averages like this. This is not a one candlestick strategy. So you will be using the swing. Place your stop loss here. Place your stop loss there, and you are good to go. Okay. Oop. We want to make it a solid line, and you are good to go. Guess what, guys? The price just went up. Yes, it was going up and down, up and down. The buyers and the sellers were fighting. The buyers are pushing the price up. The sellers are pushing it down, up and down, until boom, it began to go up. You see, if you don't understand market psychology, you enter the trade where, let's see, you enter the trade, say you enter the trade here, you know, and when the price began to go up and down, you might panic and come out of the trade. No, it's a strategy that has an over 70% winning. Guess what? If your strategy has a high probability, is a high probability winning strategy, enter with confidence. After all, there are only two things that can happen. Only two things, nothing else. The chart is not going to explode in your face. Don't be afraid. This is not a bomb. It's not a bomb. It's just the market. The price is either going to go and hit your stop loss, or it will hit the take profit. Either of two things. But because it has a high probability winning setup, enter with confidence, knowing that if you lose, you are going to lose a little. If you win, you are going to win a lot. So in this case, like I say, if the price leaves close to the moving averages when it's lined up like this, go for at least 1 to 3. Here you got way more than 1 to 3. My goodness, like 1 to 10. Let's see, that's 15. Let's just say 20 for easy calculation. Let's say 20 pips. From here to 100, that's 1 to around, that's about 100. That's 1 to 5. You got 1 to 5. You know, here you got 1 to plus another 20. That's another, you know. So that is huge, guys. About 1 to 6 or so. That is huge. Now, when I say 1 to 1, 1 to 5, what I mean is basically you are risking $1 to gain $3. So a risk reward, we call it RR. Some might write it like this. Oops, that's a dot. Oops, what am I doing? Let's do this. A risk reward. It's either written like this or written like this. A risk reward of 1 to 3. That is good. So you are risking $1 or €1 or £1 to gain 3. I think that's a good reward. This one we just, you know, analyzed was like 1 to 6. So you are risking 1 to gain possibly $6 or pounds. That is good. But anyway, we'll leave it here. I'll just open it up now for some questions. If there are any, let's hear it. Unmute yourself and ask away. You know, we've got just a few minutes and we are done. Guys, have you forgotten that we tend to start? I know there was a time change. I know the time did not change in Nigeria or in Africa, but it did change here in the UK. So our 7 o'clock became 8 o'clock. So we are now the same time as UK time, as Nigerian time. I don't know if you guys, some of you guys know, but during the summer, our time changes, you know, or during the spring, our time moves ahead by 1 hour. And during the winter, it moves 1 hour behind. So overnight, 12 midnight became 1 o'clock. So that's why we are now the same time as Nigerian time or African time. So maybe that's why some of you were late. That's understandable. So anyway, if you have any questions, ask away in some minutes. Otherwise, we're gone.
Sorry, it's me again. Is the time settings for the worthy place changing?
I would confirm that tomorrow morning. I mean most likely on some brokers, some brokers are, have their setup, properly. They have their system set up properly. It switches automatically, but some brokers, you have to be the ones to manually adjust it. Okay, guys, we'll call it a night. I will nevertheless leave the link to this video, this recording in the VIP channel. Note, guys, the Forex VIP channel is different from the arbitrage VIP room. So just note that, and you should be fine. There's a comment there. Okay, so we're back again tomorrow. I'm excited about this new week. I believe it's going to be another profitable week because I'm only going to be taking the best setups and nothing more. Okay, guys, so have a good evening and have a good trading day. See you hopefully tomorrow morning. Now, for those of you who joined late, note that the first few minutes of today's recording basically was kind of like basic or elementary, just in case you are more advanced, just fast forward a bit and we began to look at some more advanced stuff. Okay, now, see you.